Hi everyone, welcome back to my channel. Today we're going to go through what I believe might be the 2024 CFE topic. If you're not sure what the CFE is, it's basically the final exam of the CPA program here in Canada. And if you like what you see, please give this video a thumbs up. And if you like the content in general, you can subscribe as well. I normally put out content about accounting or personal finance. So last year, I predicted that they're going to have something around government grants and subsidies, as a lot of companies are coming out of COVID and the government gave out a lot of money to companies to support them through that hard time. If you haven't seen that video, I encourage you all to go check that out as well. So how it works is every year CPA tests candidates on a complex topic that not everyone has studied for. I know in my year, they tested on pension accounting. Another year, they tested about consolidation. And another year after that, they also tested about government grants. This year, my prediction is going to be that we're going to talk about foreign currency transactions, specifically IAS 21. And this relates to how we're going to transact in terms of exchanging money from Canadian to US or other currencies. As each company now is going global, they want to get more sales, they want to expand their borders, they want to expand their reach. I believe that this would be a hot topic for any companies in Canada trying to go abroad. So the overview for today is we're going to talk about what are some of the key terms that you need to know, what is IAS 21, and then explain that through a case application, and then go through an example of how that works with loans, and then another example related to how that works with functional and reporting currency. So let's look at what this actually is. Foreign currency transactions are essentially completing transactions in different currencies. That could be, for example, if you have Canadian dollars and you're in Canada, you're doing something in the US and you need US dollars to complete a transaction, or vice versa. You could be in the US and you would need Canadian dollars to complete your transaction. Some key dates to remember are the transaction date, the reporting date, and the settlement date. What the transaction date is, it's essentially the date that you've transacted with someone. So for example, it would be the date that you actually purchased your product from, let's say, a US supplier. Your reporting date is essentially the date where your financial statements have to close and you have to do your closing entries. And then the settlement date is the date in which you pay your US supplier. Some other key terms that you might want to know about would be the spot rate, which is the rate of exchange for a specific currency on a specific date or time. A forward contract is essentially an agreement between the bank and a customer to exchange currencies of a specific future date at a specific rate. So it's agreeing to buy something at a specific rate in the future. A forward rate is the agreed upon rate of that forward contract. Historical rate is essentially the rate on the date of the transaction. So it's like looking back, what was that exchange rate on that day? The closing rate is the closing rate of that exchange on a particular day. And then the average rate is essentially the weighted average of historical rates over a period of time. So now let's look at what IAS 21 says. Essentially, it says that at the initial measurement, you want to figure out what is your functional currency, and then you want to figure out what is the spot rate on that date to the currency that you want to exchange to. So for example, if your functional currency is Canadian and you want to get to the US dollar, then you would figure out what is the exchange rate on that one day, and then you would multiply the two to get your Canadian dollars into US dollars. Subsequently, there's monetary items on the balance sheet that will be translated at the closing rate of the financial reporting date, which is, let's say, December 31st. For non-monetary items, those ones are actually measured at historical cost, which should be translated at the date of the actual transaction. So for example, something that you've bought a while ago, like plant, property, and equipment, it will actually be exchanging at the date of the actual transaction, which is a while ago. For non-monetary items measured at fair value, you would actually use the exchange rate on the date when there was fair value measured. So as some of you are studying for the CFE, you might ask yourself, what does this have to do with me when doing my cases? Well, one example of how this can actually be tested on exams would be asking for what is the functional currency? because without knowing the functional currency, you wouldn't know what to translate things to. And why it's important is because sometimes what we report to what we actually use as our functional currency might be different. So for example, you might be an entity that is in Canada, and thus you report using Canadian dollars. So your statements are all done in Canadian dollars. However, your functional currency can be something different. And there's various indicators to determine what is your functional currency. So on this slide, you can kind of see what are those various factors. The first factor is your sales price. Are your sales in Canada? And is it denoted in Canadian dollars? If yes, then your functional currency is also Canadian. If not, then you're probably using something else. The second indicator is operating costs. Do you pay all of your labor, your materials, all your suppliers using Canadian dollars? If yes, you're using functional currency as Canadian dollars. If not, then you're using a different currency. Number 3, is your competition and regulation also in Canadian dollars? If yes, then functional currency is Canadian dollars. If not, then you're not. And then there's your financing. So where are you getting money from? So are all of your borrowers giving you money in US dollars or Canadian dollars or some other type of currency? Whatever currency they're providing is probably also an indication of what is your functional currency. And lastly, there's the operating surpluses, which is if you have extra cash, what do you do with that extra cash? Do you hold it in Canadian dollars or do you hold it in something else? Essentially, at the end of the day, functional currency is the currency of the primary economic environment in which the entity operates. So let's look at our first example, and this one has to do with loans. So it says that Happy Cat Inc., HCI, a Canadian entity whose functional currency is the Canadian dollar, made a loan of $4 million in US on January 1st to a cat litter company at an annual interest rate of 12%. The loan is due on December 31st of the fourth year, and the interest is paid annually on December 31st. The exchange rates for $1 Canadian over the life of the loan were detailed below, and you see all the different exchange rates. So the question would be, exchange rates changed evenly throughout the year. The requirement here is prepare journal entries for HCI in year 1. So as you can see in the solutions, we made essentially a $4 million loan in USD to the supplier. And $4 million Canadian need to be converted to USD at the spot exchange rate as of January 1st in year 1. And that was $1 Canadian became 0.86 US dollars. So as a result, we needed to give away $4.6 million in Canadian for that $4 million loan. And then on December 31st, the essentially reporting date came, and we have to now revalue our loans. Because the loans are a monetary value, we have to revalue it at the spot rate at the end of the year. As a result, we realized that the spot rate at that point in time is now 0.83. And this means that we actually made money off of the loan that we gave out. And the reason for this is because if we had to convert the $4 million USD back to Canadian dollars in today's currency, it'd actually be worth more than the 4.6 million that we used initially to convert into US dollars. And how you figure that out is if you use the inverse of 0.83 or the inverse of 0.86, and then you'll realize that you needed more money than the $4.6 million initially. So in addition to that, you will also have to charge some interest. So this interest amount was 12% on the $4 million, which came out to $480,000 in USD. As a result, we have to journalize this in Canadian dollars. So using the spot rate of the year end, which is 0.83, we translated that $480,000 USD to $578,000 Canadian. Now you might ask, how is this actually different from if I had a loan in Canadian dollars to another company in Canada? And to be honest, it's pretty much the same. The only thing that you actually did extra here is to understand when is the spot rate and when is the reporting date so you can revalue your loan. So now let's look at a second example. This one's about functional versus reporting currency. Mapletech Inc. is a Canadian technology company that manufactures and sells software products. The company has significant sales in the United States and Europe. Most of its expenses, including salaries and manufacturing costs, are incurred in Canadian dollars. The company also has a loan in USD. The financial statements are denoted in Canadian dollars, and Mr. X is unsure if the functional currency is also Canadian dollars. So in terms of how to solve this, you'd refer back to what we learned in the previous slides about functional currency. So I'd start my response with, as per IAS 21, the following are indicators to determine what is the foreign currency of an entity. The first being sales price, then operating costs, competition and regulation, financing, and then operating surplus. In this case, we don't really have competition and regulation, nor do we have operating surplus, so I just put does not apply. However, we do have sales price, and a lot of the sales is done in the US and in Europe. As a result, that's probably the currency that they're selling their products in. Second, for the operating costs, you see that in the case it talked about how they do pay a lot of their expenses in Canadian dollars, which does support the Canadian dollars being their functional currency. However, when they went to financing, they said that they do have a loan that is in USD. So that helps also support USD. So as a result, I say based on the above, with significant sales made in the US, assuming it's using US dollars, and loans provided in US dollars, I would recommend that the functional currency is US dollars, even though its reporting currency is Canadian. And I know a lot of you would also think, well, it's not definitive that its functional currency is the US dollar. However, when you're writing a case, as long as you can prove that there is a possibility that you're right, the solution isn't really as rigid as was it US that you sided on or was it Canadian that you sided on. So as long as you stated one of the currencies and then you made a recommendation, that's fine. Thanks so much for watching. If you liked what you saw, please remember to subscribe, like, and leave a comment. If you think that this video can help someone else, feel free to share it with them as well.